Hello, and welcome to the Commodities Institute podcast. I'm Emily Costa. Today is January 6th, 2026, and as we step into the new year, the commodities complex is already delivering a powerful reminder that markets never move in isolation. Politics, weather, technology, and trade are all colliding at once, and the consequences are rippling across oil, metals, agriculture, power, and freight. Let me start today not with oil, as we so often do, but with copper, because copper is telling us a story about anxiety. Prices have surged to record levels above $13,000 per metric ton, and that headline number matters less than the psychology behind it. Copper is the metal of electrification. It runs through data centers, electric vehicles, power grids, and renewable energy systems. When copper rallies this aggressively, it is signaling fear that supply simply cannot keep pace with the world's ambitions. Last year alone, copper prices climbed roughly 40%, driven by demand growth tied to artificial intelligence infrastructure and electric transport. But what is really fueling this move is the sense that the mining industry has very little slack left. Many of the world's largest copper mines have been pushed beyond their original design limits for years. Accidents, labour strikes, and geological challenges have become more frequent. Analysts are now openly saying that prices need to stay this high, or even move higher, to justify the billions of dollars required to build the next generation of copper mines. That is not a short-term fix. That is a decade-long investment cycle. Layer on top of that the geopolitical tremors coming out of Venezuela, and suddenly copper is no longer just about wiring and cables. It is about security of supply in a fractured world. Even though Venezuela is not a major refined copper producer, the sudden intervention by the United States and the removal of its longtime leader has sharpened fears that critical minerals everywhere could become political leverage points. Copper is rallying not just on demand, but on distrust. That brings us inevitably to oil and to Venezuela itself. Over the weekend, US forces carried out a lightning operation that resulted in the arrest of Nicolas Maduro and his transfer to the United States. Within hours, the conversation shifted from geopolitics to barrels. The Trump administration has signaled its intent to meet with US oil majors to discuss rebuilding and expanding Venezuelan oil production. On paper, Venezuela is an oil giant. It holds the world's largest proven reserves, and its heavy crude is particularly well suited to specialized refineries along the US Gulf Coast. In reality, years of underinvestment, sanctions, and political mismanagement have left production at roughly a third of its historical peak. Bringing that output back would require not just goodwill, but billions of dollars and many years of work. There is also a gap between political rhetoric and corporate reality. While Washington talks confidently about oil companies being ready to invest, industry executives remain cautious. Chevron is currently the only US major still operating in the country, and even its presence has required careful navigation of sanctions and shifting policy signals. Other companies, burned by nationalizations and long arbitration battles in the past, are understandably wary. Meanwhile, despite a US blockade on sanctioned tankers, Venezuelan crude has continued to move. Roughly a dozen tankers loaded with oil and fuel have slipped out since the start of the year, many sailing without flags or satellite tracking. An estimated 12 million barrels are now at sea, much of it likely destined for Asia. This shadow trade underscores a recurring theme in global oil markets. When supply is constrained, flows adapt, often in opaque and risky ways. Chevron, for its part, has resumed exports to the United States after a brief pause, shipping hundreds of thousands of barrels to the Gulf Coast. That contrast between Chevron's relative stability and the chaos facing Venezuela's state oil company highlights how deeply fractured the country's energy system remains. Let's pivot now to agriculture, where weather, once again, is rewriting expectations. In Ivory Coast, the world's largest cocoa producer, unseasonal rains have arrived during what is typically the dry period. Farmers report that these rains are strengthening the main crop and improving bean quality heading into the latter part of the season. For chocolate markets, that matters. After years of tight supply and volatile prices, better yields could bring some relief, though much will depend on how weather patterns evolve through February and March. In Eastern Europe, the agricultural picture is more complicated. Ukraine's sugar industry has nearly zavershed processing its latest sugar beet harvest, producing around 1.5 million metric tons of white sugar. That is well below historical levels, reflecting not just market pressures from cheaper cane sugar, but the profound impact of war. Population displacement, lower domestic consumption, and export challenges are all reshaping what was once a major regional producer. Grain exports from Ukraine also declined in December, with shipments of wheat and soybeans falling sharply. Export duties, infrastructure damage, and ongoing attacks on ports continue to constrain flows. Agriculture remains the backbone of Ukraine's export economy, but it is operating under extraordinary strain. Contrast that with Brazil, where scale and momentum are on full display. Brazil shipped a record 108.68 million metric tons of soybeans last year, driven by a bumper harvest and strong demand from China. Soy meal and corn exports also hit new highs. As trade tensions reshaped buying patterns, Brazil cemented its position as a dominant supplier, and freight markets have felt the pull of those volumes moving toward Asia. Before we wrap up, let's touch on power and energy security. In the United States, the government has awarded billions of dollars in contracts to boost domestic uranium enrichment. The goal is clear: reduce reliance on Russian supply and secure fuel for both existing nuclear plants and the next generation of advanced reactors. High-assay, low-enriched uranium, or HALEU, is central to that strategy, even as critics warn about proliferation risks. This is another reminder that energy transition does not eliminate resource dependency, it rearranges it. Stepping back, what ties all of these stories together is fragility. Whether it is copper mines stretched to their limits, oil infrastructure hollowed out by years of neglect, crops at the mercy of shifting weather, or nuclear fuel chains caught in geopolitical crossfire, the global commodity system is operating with very little margin for error. As we move deeper into this year, volatility is not a bug. It is a feature. And understanding the forces beneath the headlines has never been more important. That's it for today's episode of the Commodities Institute podcast. If you found this episode valuable, be sure to subscribe, share, and leave a review.